This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
All right, I'm going to go through question 5 from the paper F9 March-June 2016 hybrid exam. So as always, make sure you've got the question in front of you, that you've downloaded, printed it out. But let's have a look. And here, unlike some of the other questions I've been through, this one, there's quite a lot to read at the top. So before reading it all and spending too much time, do check to see what's required. Part A, calculate the expected net present value of the planned investment for the first 4 years of operation. And that's the big bit, it's 7 marks. It then carries on, calculate the effect on the net present value of continuing to produce. I'll worry about that when I come to it, but that's only 3 marks. And then, as standard in the long form questions, there's a written bit, part C, critically discuss the use of probability analysis. But the main bit will do all the bits, obviously, and you must attempt all the bits in the exam. The main part is part A, and it's net present value. And clearly, you're going to get a big net present value of one form or another. And so we want to get into it as fast as we can. Now let's start reading. Remember, we're calculating the expected net present value of the planned investment for the first 4 years of operation. And so I'd immediately start setting up the table for the cash flows. If it's 4 years, do it in columns, 0, 1, 2, 3, 4. And now so let's start going through the flows, through the questions, see what flows we can get down. Dagnis is a company which installs kitchens and bathrooms to customer specifications. It's planning to invest 4 million in a new facility to convert vans and trucks into motorhomes. Each motorhome will be designed and built to customer requirements. And they've given us the production and sales in the first 4 years. So there's how many units we're going to produce and sell. The selling price depends on the van or truck which is converted, the quality of the units installed, and the extent of conversion work required. We've undertaken research into likely sales and costs of different kinds of motorhomes, which can be selected as follows. So there are 3 types. They've told us the probability of each type being selected. They've told us the selling price of each type. And so surely as soon as you see probabilities and in the question the word expected, what we're going to have to do is work out the expected, the average selling price, and use that in our cash flows. And so do show workings, proof, make it clear where you're getting your figures from. So although I'll come back to the first figure in my cash flow table is going to be the sales revenue, but let's show workings. How am I going to work out the sales revenue? Well, there's no mention here of any inflation, thank heavens, but there are those 3 selling prices. So the selling price is either going to be 30,000, 42,000 or 72,000 per unit. We know the probabilities, 20% or 0.2, doesn't matter, 0.45, 0.35. And so the expected, the average selling price, multiply and add. 0.2 times 30,000 is 6,000. 45% of 42,000 is 18,900. 35% of 72,000 is 25,200. It gives me an expected selling price. 6,000, 18,900, 25,200, 50,100 per unit. Make your workings neat, because the nice thing about net present value questions is each cash flow will get marked separately. And so, I'll get a mark just for getting the 50,100, whatever else I manage to do right or whatever other mistakes I might make. But as long as it's clear, it's no good just doing it on your calculator and taking the risk. You must show you know what you're doing. So on that basis, we can now calculate the total sales revenue each year. It's 50,100 per unit. Let me write it down temporarily to save me going up and down the screen. That won't be your problem in the exam. But in the first year, 250 at 50,100 each is, lots of zeros, 12.525 million. Don't stick loads of zeros. I mean, you wouldn't lose marks, but it's just wasting time. Generally, this sort of question do in thousands. And so it's 12,525,000. Similarly, at time 2, it's 300 at 50,100, which in thousands is 15,030. At time 3, 450 times 50,100. Sorry, how many was it? 450 times 50,100 is, something's gone wrong with my calculator. Sorry, one more time. 450 times 50,100 is 22,545. And finally, at time 4, same again, 450, so 22,545. So there's another, probably half mark. What else? What about the costs? We've got the conversion cost. Again, we've got probabilities here. So again, I'm going to need workings. We're going to have to use the average conversion cost. It's going to be either 23,000, 29,000, 40,000. 0.2, 0.45, 0.35. And so, same way as before, 23,000 times 0.2 is 4,600. 29,000 times 0.45 is 13,050. 40,000 times 0.35 is 14,000. So the expected cost for 600, 13,050, 14,000 is 31,650 per unit. So there's another half mark. And so again, let me make a note, then I don't wind up and down. 31,650. And so what are the conversion costs? Well, again, multiply by the number of units. So first year, 250 times 31,650 is 79. I'm doing it still to the nearest thousand, obviously. So 7913. Next year, 300 times 31,650 is 9495. Next one, 450 times 31,650, 14,243. Doesn't matter whether you round up or down. Irrelevant. And of course, the fourth year is 450 again, so it's the same figure. Any other costs? Well, there's the only variable cost. I have a feeling the examiner's answer shows the contribution, sales less variable costs. But there's no particular need. Why waste time on making a arithmetic mistake? But regardless, there are fixed costs of the production facility. So these are extra fixed costs to the business if we go ahead with this new business. But the fixed costs depend on the number of units a year. They're either 4, 5 or 5, 5. So in the first year, it's 250 units. Well, that's between 200 and 299. So the fixed costs will be 4,000. In the second year, it's 300. Well, that's the range 300 to 399, so there'll be 5,000. In the third and fourth years, it's 450. So that's in the top range, 400 to 499, 5,500 in each year. Any other operating flows? No. And so the net operating flow time 1, 12, 525 minus 7913 minus 4,000 is 612. At time 2, $535. At time 3, $2,802. And at time 4, all the same figures, so 2,802. All right, we've still got the initial cost to bring in, but we do have to deal with tax. It says they pay tax at 28% per year. And if you've watched my lectures, you'll know there are two ways we can deal with tax, which end up giving exactly the same answer. The easiest way, I always think, is first of all to ignore for the moment any capital allowances, tax allowable depreciation, and to calculate the tax on the operating flows. And then deal with the capital allowances separately. So it's up to you. I'm not going to show both ways on the screen. You'll have to watch my lectures if you're not clear. But if we ignore capital allowances for the moment, the tax will be 28% of the operating profit. So 612 times 28% is 171. Check the timing. You know, very often it's 1 year later, and if it was 1 year later, the tax would be payable at time 2. But here the tax is payable in the same year as the flow, so there's a tax outflow of 171 at time 1. I will write down the 28%, simply because I know more than one occasion where it's been easy to pick a wrong percentage or something. Well, again, it's clear what I'm doing. The more it's clear to the marker, the more certain I am to get the marks. Anyway, let's carry on. It's 28% each year, so 535 times 28% is 150. Keep it all to the nearest thousand. 2,802 at 28% is 785. And again, a bit of time saving. Time 3 and 4 were the same. All right, that's all the operating flows. So the next thing is to look for any capital flows. The cost of the machine, the investment. Well, that's where the second line of the question. At time 0, there's an outflow of 4 million. There's no mention of any scrap, and quite deliberately, because the question asked us just to do an NPV for the first 4 years, but it doesn't say anywhere we're stopping after 4 years. Presumably it's carrying on for a long time. But we've just only been asked to do the first 4 years. And we're not going to scrap it at the end of 4 years, so no scrap to bring in. However, by virtue of the investment, there'll be capital allowances or tax allowable depreciation. And so the way I do the tax, we've got the tax on the operating flows themselves, but there'll be tax saving on the capital allowances. And how they calculated here, the last paragraph of the question itself, the company can claim tax allowable depreciation on the cost of the investment on a straight line basis over 10 years. So they kept it nice. If it was reducing balance, we'd have to show separate workings. What are the allowances each year? What's the tax saving? But because it's straight line, it's going to be the same each year, and I can show the workings here. What is the depreciation? Straight line over 10 years, so 4,000 over 10, it's 400 per year. And how much tax will that save us? Well, at 28%, 400 at 28% is 112. And again, there's no delay, nice and easy. It's a saving of 112 each year. No scrap, no balancing allowance, balancing charge at the end, because we're not stopping after 4 years. It's just that we've only been asked to do the calculation over 4. And so that's that. Finally, is there any working capital? No mention of working capital. So we've got all the flows. So what's the net cash flow each year? An outflow at time 0 of 4,000. At time 1, 612 minus 171 plus 112. And net 553. At time 2, 535 minus 150 plus 112 is 497. 2802 minus 785 plus 112. Can't be right. Oh yes, it is 2129. And of course, the same at time 4. So there's the net cash flow. And of course, finally, the easiest half mark of all, or certainly should be, we need to discount. So the discount factors at, what's the cost of capital? We use an after-tax discount rate of 11%. And so straight from the present value tables, 11% for 1 year, 0.901, 2 years, 0.812, 0.731, 0.659. The present values. 498, 404, 1556, and finally 1403. And so, last of all, the net present value. What's the total? 498 plus 404 plus 1556 plus 1403 minus 4,000. The net present value is negative. It's 139. And there we are. We're not asked to make any comments, so I won't waste time. Positive, accept, negative, reject. We're not asked for a comment. It's purely calculate the expected net present value. So there's quite a lot there. But I said before, the nice thing about NPVs is it's not the final answer there that gets the marks. Each row, if you like, sales, conversion costs, each row is marked separately. It may be half a mark if it's trivial, it may be 1 mark, it may be 2 marks, depending on the work needed. But each line's marked separately. So, even if you've got one wrong or misread, or you've got your fixed costs wrong, you can still get the marks for everything else and easily get pass marks on that part, provided you're setting it out neatly, the marker can follow it, and that where you did need workings, you've at least shown what you're doing, so that, as I said before, you can still get credit for trying to do it the right way, even if something's gone wrong. Anyway, that was 7 marks, so we're nearly getting the 50% that we're aiming for on every question, but we've not got it yet. So let's go on to part B. It's only 3 marks, so don't waste too much time. If you find it's taking ages, it probably means you've misread, So it'd be better to give up and do part C. But part B says, after the 4th year of operation, Degnis expects to continue to produce and sell 450 motorhomes per year for the foreseeable future. So we've only looked at the first 4 years, but in fact they're going to carry on from year 5 onwards. And it says calculate the effect on the expected net present value of the planned investment of continuing to produce beyond the first 4 years. So we've got in part A the MPV for the first 4, but we need to know what extra present value will be if they carry on. So what will the flows be? If they carry on, it's going to be every year from year 5 for the foreseeable future, a perpetuity. And what's the flow going to be? Well, it says they'll continue to produce and sell 450 homes per year. Well, that's what we had already in years 3 and 4, and the final flow in 3 and 4 was 2129. But we are going to have to be careful, and this is the reason. I'll do it separately. You see, the sales will carry on at that level, 22,545. The conversion costs, 14,243. The fixed costs, 5,5. And so the operating profit will be 2,802, and the tax on it will be 785. And they'll continue in perpetuity. The bit we have to be careful about, though, is the tax saving on capital allowances, because it's straight line over 10 years. So we'll carry on getting it we had it for 4, we'll carry on getting it for another 6 years, but that won't carry on in perpetuity. So that will carry on in perpetuity, and it's how much? 2802 well, I'll write them down separately. 2802 and 785. 2802, 785. That'll be 2017 per annum. The capital allowance saving it was 112 a year, and it's a saving. But how many more years? Well, we've had it for the first 4, we get it for another 6. So 5, 6, 7, 8, 9, 10. 5 to 10. And so those are the extra flows we're going to be getting. We want the present value of those. And how are we going to do it? I'll do the 2 separately. First of all, 5 to infinity of 2017. Now, there are 2 ways you can do this. And what I'm going to do, what's the discount factor for a perpetuity? For a perpetuity, we multiply by 1 over r, and the discount rate is 11%, so 1 over 0.11. However, that gives us the present value if the flows are 1 to infinity. Here, it doesn't start at time 1, it starts at time 5. It starts 4 years later. And so whereas, had it been 1 to infinity, what's on the screen would have given us a present value now. Here, because it starts 4 years later, what's on the screen gives us a present value in 4 years later, in 4 years' time. So we then need to discount for 4 years at 11%. And 4 years at 11% is 0.659. And so the present value of those flows, 2017 divided by 0.11 times 0.659, is 12084. Now, I said there are 2 ways. The alternative, if you prefer it, is to say r from 1 to infinity, it's 1 over r. We only want 5 to infinity, so subtract the factor for 1 to 4, which is the 4-year annuity factor. Now, I'm not going to do it. It'll end up exactly the same answer. Slightly different because of rounding in the tables, but you don't lose marks for that. So don't worry, it's your choice. Either 1 over r and then discount for 4 more years, or 1 to infinity 1 over r less the 4-year annuity, and we're left with 5 to infinity. However, that's only the first bit of it. We've dealt with that bit. What about the capital allowance saving? It's 5 to 10 of 112 per annum. Well, here there are 2 ways, but here, without doubt, the easiest way is to say, well, if it was 1 to 10, it'd be the 10-year annuity. And the 10-year annuity factor at 11% is 5.889. We only want 5 to 10, and so we need to subtract the total for years 1 to 4, which is the 4-year annuity. And at 11%, the 4-year annuity factor is 3.102. Which leaves us with a net factor to apply. .787. That's the total factor for 5 to 10. And if we apply that to the tax saving, 112 times 2.787 is 312, giving a total of, I should have left more space in, a total present value of those flows of 12,396. Now we're virtually there, but what did the question actually ask for? It said, calculate the effect on the net present value of continuing to produce. Well, there is the effect. The present value will increase by that amount. And comment on the financial acceptability of the planned investment. Well, we'd only in Part A looked at the first 4 years. Now we've looked at the rest of its life. And so the overall NPV of the whole thing. Part A, first 4 years were minus 139. The others are plus 12,396, which means an overall NPV of 12,257. Although do remember these were all in thousands, so it's actually 12.257 million. And of course, to fully answer the question, comment on the acceptability. Well, if it was only going to last 4 years, obviously we wouldn't do it. But since overall it's positive, we will accept the project. Now again, that does seem rather a lot for 3 marks, but as always, bear in mind I'm talking through it, so that I still think it's a bit of a push. Certainly it wouldn't have taken me anything like as long if I hadn't been speaking and trying to explain. Finally, though, Part C. And I've said in lots of other lectures going through exam questions, in long-form questions you must make sure that you do something for each part of the question. You must. And too many people, you see, because it does take time here to do Part A and Part B, and obviously there's always a risk of getting stuck somewhere. Too many people do Part A, perhaps get it nearly right, do a bit of Part B, run out of time, but end up doing nothing for Part C. You must, even if you only write 1 line, the chances are you're going to get a mark, and that may turn the overall mark from 49 to 50, a fail to a pass. And you see, and it's usually the case, you could answer Part C completely independently, even if you'd done nothing for Parts A and B. it says critically discuss the use of probability analysis in incorporating risk into investment appraisal. Critically discuss. So what he really wants is a brief explanation of what it is he's talking about, but also critically, limitations. Well, surely what we've done earlier, it's clear what it is he's talking about. That when you've got various possible outcomes here, various possible selling prices, what we are capable of doing is use the expected or average price or costs in the appraisal. Not the individual ones. I'm not writing that very well, but I think you know what I mean. So that's what we're talking about. But what are the limitations? What are the problems with that? The problems are, first of all, surely how to estimate the probabilities or the accuracy of the probabilities. But it's all right saying here, oh, the probability of selection is 20%, 45%, 35%. But where on earth would you get those figures from? And of course, if any of those probabilities turned out to be wrong, the expected value is wrong, and it could change the decision. Perhaps not here, but I think you know what I mean. So that's one huge problem. And the other problem, main problem, is that by using the average, I've used an average selling price of, what was it, 50,100, the same, an average for the costs, is of course, even though in the long term, hopefully, that will be the average, the actual figures, a basic one makes what, 7,000 contribution, 30 minus 23. A deluxe one makes 32 contributions, 72 minus 40. And so it's ignoring the fact that some, as I refer to the question, some types of these homes give much more than average. Others give less. And that's the main bit, apart from accuracy, obviously, probabilities. The main bit with reference to risk. You see, if they all gave, I got an average selling price of, what was it? Again, 50,100. If all of them were giving very close to 50,100, if some had a selling price of slightly more, 1,000 more, and others had a selling price of slightly less, 1,000 less, then I'm not too much risk, It's going to be very close to 50,100, even if the probabilities are wrong. But on the other hand, if there's a big difference, if some are giving a selling price of 100,000 and others are only 1,000, all right, we're using this average. But that's when we've got a big problem, that it may, some are giving a lot more, some are giving a lot less. And especially if any of the probabilities are wrong, well, that creates a lot more risk for us. The bigger the spread of the possible returns. Some give a lot more than average, some give a lot less than average. The more the risk. So that's what he's really getting at. There are ways, not for F9, but there are ways we could try and measure that risk. I think he mentions in his answer standard deviation. You don't need to deal with that at F9, that's at P4, and even then, rarely. But there are ways you can measure that spread between the high and the low. But the more it might be high or it might be low, the more risky it is. The idea of using just the expected average. So yeah, I mean, that would get me, that would probably get me all 5. It's certainly get me most of them. But there we are. Question 5.